Hi, I'm Mark King, Head of Content at Columbia Threadneedle Investments, and welcome to our second episode of Credit Threads, a special fixed income focused podcast from the Eye of the Needle team. Credit Threads takes a regular look at macroeconomics, central banks, and inflation, and their impacts on credit markets. We'll also do a deep dive into a particular fixed income asset class, all while trying to keep the conversation lively and jargon-free. So, joining me for this episode are Jason Callan, Senior Portfolio Manager and Head of Structured Assets Core and Core Plus, Adrian Hilton, Head of Global Rates and Currency, and my co-host Chris Morton, Fixed Income Client Portfolio Manager. For this episode of Credit Threads, we'll be talking about consumer balance sheets and why paying attention to the consumer is important for fixed income investors. So Chris, I was hoping maybe at this point you could just take a minute to talk about what we mean by consumer balance sheets, because I think all of us are aware of what a corporate balance sheet is, but maybe we don't know what it means for consumers. So why is the world divided up in that way?
Yes. Hi, Mark. I totally agree with you. If I think back to Accounting 101, we were all taught about the composition of the balance sheet, assets versus liabilities and shareholder equity, and how that really related to the creditworthiness of a corporation. Well, the same exact metrics can be used to be said, and analyze the consumer. We can analyze the average debt burden on consumers. Are consumers leveraging up? Are we borrowing beyond our means? How strong is debt service relative to our incomes? And if I think back to 2008 and the dynamic there, we were faced with a great financial crisis. And the consumer was not in very good financial health to weather that storm. Prior to the onset of that recession were the go-go days of subprime lending, and lending standards were quite loose and access to credit was very easy. And so consumers did lever up, and we all know what followed. So as investors, we all know how to access corporate balance sheets. We can invest in investment grade corporate bonds, we can invest in high yield corporate bonds, and we can invest in dividend paying stocks, for example. But today we're going to focus on the financial health of the consumer, given this global pandemic we've just been through, and how investors can actually tap that dynamic and invest in the consumer. So Jason, I would like to start with you. When I look at consumer metrics, it seems to me that the consumer has held up pretty well, at least in the US. During COVID, there were significant fiscal support programs put in place to shore up the households when unemployment skyrocketed. And now we are seeing very strong gains in employment and rising wages. And the savings rate is much higher. We had nowhere to go. And so our credit card debt really did come down. So can you talk a bit more about what you're seeing in terms of consumer balance sheets before the pandemic as well as today?
Yeah, certainly. Thanks, Chris. When we think about, where the consumer is today, they're in, quite a strong position from a credit worthiness. You had mentioned that savings are a bit elevated in today's environment, but in addition to that, there's been a pretty meaningful buildup in wealth. If you think about it through the lens of either the housing market and home prices that have gone up by about 17% on a year-over-year basis, or the stock market with the equity market effectively being at all-time highs. And so to draw on the same analogy of thinking about kind of the balance sheet and the income statement of the consumer, it was one that they were in a fairly robust position going into COVID. The COVID shutdowns created, mass deterioration and a kind of global slowdown in economic activity. The unemployment rate shot up from what was, mid 3% to 15%, and a lot of uncertainty. But that uncertainty was quelled with a lot of fiscal support. Some of which you mentioned, increase in unemployment benefits and extension of the timelines of unemployment benefits, implementation of forbearance moratoriums or foreclosure moratoriums, things of that nature, to ultimately ensure that distressed assets and consumer delinquencies didn't produce an unnecessary burden as an offset to the COVID-based health shutdowns. In going through that environment, the consumer came through in a much more resilient manner, I think, than most would have even thought. And then coming out of it, the consumer is dramatically better positioned. Again, getting back to those two metrics, if we think about the debt load relative to either wealth, debt on the consumer side is clearly ticked up on an absolute term basis. But if you think about it on a relationship basis relative to either GDP or relative to overall household wealth, it's actually gone down quite a bit. So from a balance sheet perspective, the consumer is very, very well positioned. And then if we think about it, secondarily as a frame of reference around the income statement, how easy is it for consumers to service their debt? With interest rates very low, with the vast majority of their debt being mortgage-related debt that makes up about 70% of consumer debt, the serviceability of that debt is as easy or as low as it's ever been. The Federal Reserve produces this metric on a quarterly basis, which is called the Household Financial Obligations Ratio. It basically just looks at how expensive, as a proportion of household income, does it cost to service that debt, and it's the lowest that it's been on documented record, and that's going back to about 1980. So we have 40 years worth of history to just kind of highlight, how attractive the consumer is from a balance sheet perspective as well as an income statement perspective. So the creditworthiness of the consumer is very strong in today's environment.
You mentioned HPA in the housing market. I'm starting to get questions on that, actually. That we're hearing more about affordability as home prices continue to accelerate. There's some data to suggest that potential home buyers might be opting out. They're pushing back and they're sitting on the sidelines. They're exhausted by the process of bidding and losing, and maybe wanting to see prices kind of start to simmer down a little bit. Do you expect the housing market to slow down, and does that impact the markets that you invest in?
Yeah, I can understand the frustration on behalf of the consumer as property prices have moved higher in a meaningful way over the last year and change. With property prices up, 16.5% on a year-over-year basis, they're clearly more expensive and inherently less affordable. We haven't seen income growth at that same kind of pace, and so it naturally becomes a little less affordable. But when we look at affordability versus kind of the traditional lens, we're kind of at a median level over the last 20 plus years. So properties look a little less affordable post the financial crisis, but in the lens of thinking about it over the last kind of 20 years, 2000 up until 2008, they're still more affordable by today's metrics than what they were back then. While property prices have appreciated in a fairly meaningful manner, we don't expect a material slowdown in overall housing activity. Maybe a little bit on the new home side of sales, where properties tend to be a little bit more expensive on new home sales, and it tends to lean a little harder on the affordability side of the metric. But in terms of the overall nature of the housing market, it's one where the dynamics are still quite favorable. And while we expect home price appreciation, the rate at which property prices have been going up, we do expect that to slow. We don't expect that to turn negative, or we don't expect property prices to come back down. If we think about the most important variable, or the top two variables, I would say, that drive consumer credit as it relates to the housing market and mortgage debt, the first is going to be the backdrop of the employment market. Do people stay employed? The second is how much equity do they have in properties? And as property prices appreciate, borrowers inherently have a greater degree of equity in their property and are hence less likely to ultimately default or become delinquent on their mortgage.
Right. I think that is a major difference between today and 2008, when people walked away from properties that were underwater, versus today, where people have home equity and have skin in the game. It's something to fight for, especially as these programs start to roll off, forbearance and all. And on that note, regarding programs rolling off, I'm thinking about, a lot of some of these support programs in light of the Delta variant. We have this Delta variant now, and I'm wondering about the health of the consumer, how you are assessing some of these fiscal programs rolling off at the same time that the Delta variant might cause, a delay in a total return to normal. How are you thinking about that? Does the consumer get derailed here?
The story is still yet to be played out, but broadly, our perspective is it's going to be a bit more of a speed bump and maybe a delay or a transition in some consumer behavior. From a creditworthiness, the consumer is still in a very strong position. The handoff from a lot of the fiscal support that we've seen is a very natural transition, with the unemployment rate improving as much as it has. Now, with the more recent uptick in COVID and in particular the Delta variant, we continue to kind of monitor the situation and see how it changes kind of consumer behavior and what that means to maybe economic growth. But it's not going to mean much in terms of the change in consumer creditworthiness.
Great. Thanks, Jason. Adrian, I want to look now outside the U.S. How has the consumer held up through COVID in EMEA more broadly?
Yeah, I think the short answer is it's held up extremely well. and that the story is very similar to that in the US, only a bit less so. That's sort of often the case, I guess. The fact is that saving rates are very high on this side of the pond. In the Eurozone, for example, estimates of how much excess savings have been accumulated by Eurozone residents range between 5 and 6% of GDP. That's a huge chunk. It represents a saving rate of about 20% relative to a pre-pandemic norm of about 12 to 13%. So there's definitely been an accumulation of savings. So we haven't had that big boost to incomes like you've seen in the US. That's partly because the overall fiscal support has been somewhat smaller. It's varied country by country, but it's certainly not been quite as enormous as has been delivered in the US over the last year and a half. It's also a function of the way in which that fiscal support's been delivered. In Europe, the emphasis has very much been on furlough schemes, on ways of supporting jobs rather than supporting incomes, and so that's meant that the unemployment shock has been somewhat smaller than perhaps it's been in the US, but the incomes boost has been a little bit smaller. So it's a slightly less direct way of providing fiscal support than stimulus checks, for example. Now, as Jason alluded to, one of the things that we need to watch is not necessarily just the health of the consumer, but how much of those accumulating savings the consumer chooses to release. The other aspect is that those savings appear to have been accumulated in all the wrong places. If what you expect is for those savings to be released, and what I mean by that is that when you and the ECB, the Bank of England have both conducted research on this, when you break down which income quartiles have accumulated the most savings, it tends to be those quartiles at the top end of the spectrum, and they are naturally the segments of the population that is less likely to spend. I.e., they're more likely to regard that extra cash in the bank account as wealth rather than income, and therefore less likely to spend it. It's the same when you split it by age, that a lot of the savings have accumulated at the older end of the spectrum with a lower propensity to spend. And so that's a slight concern if we're expecting some of those excess savings to be released over the next few months and quarters.
Yes, I can relate to that, as I attest to how my children have been spending during COVID and all the hands-on packages arriving at our front door. So Jason, how does let's transition to investable options, both in the US and in EMEA. So Jason, how do we tap the strength of the US consumer from an investment standpoint?
Thanks, Chris. There's a couple different ways that we can tap the strength of the US consumer. The first is in corporate credit. So thinking about corporations that directly face consumer-based activity, restaurant services, airlines, more on the durable side, auto manufacturers, things of that nature. The second is through the lens of consumer credit-based opportunities and the creditworthiness of their underlying loans, as well as then being securitized or collateralized by the underlying asset that they're lending against. And so when we think about that, it's through the structured assets or structured product market. So things like residential mortgage-backed securities or asset-backed securities, pools of loans that are ultimately put together off of auto loans, credit card lending, unsecured consumer loans, things of that nature that ultimately get pooled together into a securitized product or a securitization. And bond investors like ourselves can ultimately invest in various components of that capital structure within the different investment vehicles that we manage.
What are some other inputs that you consider, Jason, when you're looking, other than the strength of the consumer? Like, for example, I'm thinking about the Fed taper, which Adrian spoke about at the onset of the conversation. How does that impact your investable options in the space?
Yeah, there's a lot of variety of measures that we can ultimately focus in on to think about what's the appropriate way to measure the attractiveness of an investment. When we think about things at Columbia Threadneedle, we tend to look at it through three lenses, valuations, fundamentals, and technicals. In the overarching technical has clearly been the level of Fed support that the Fed has provided in terms of injecting liquidity, starting with the spring of last year and still continuing at their current pace of $120 billion per month, 40 of that is in agency mortgages, 80 billion of that is in U.S. Treasuries. And it's not just directly supporting those asset classes. There is a spillover effect that ultimately influences kind of spreads and risk premiums in all areas of the market, whether it be equities or other kind of credit-based investments. And so that's clearly a bit of a concern as we think about, what's going to happen as the Fed ultimately does start to pare back the level of accommodation. But to Adrian's point, the Fed has been very clear, I think, in communicating this. It's very much already built into many market participants' expectations, and as such, you could say even to price levels. And so, while we might see some modest disruptions or some modest repricing over time, again, the overarching theme is that it's going to be very modest, and that's more through the lens of the technical backdrop. When we think about the fundamental backdrop, it's incredibly robust. The U.S. economy is growing at a very elevated pace. What's interesting is to kind of compare and contrast, I guess, the U.S. versus maybe what the U.K. and, as Adrian mentioned, consumption-based activity versus pre-COVID days. If we think about the U.S. in terms of like retail sales and consumer credit card activity, they're spending what amounts to be about 18 to 20% greater than what they were spending in 2019. And so you've fully recaptured kind of the drawdown or the slowdown in activity and have continued to kind of expand. The consumer continues to be kind of the growth engine of the U.S. economy going forward. And then the last piece is the valuation environment and thinking about, where valuations are and what would be key drivers for that valuation paradigm to change. And so while valuations are at the tighter end of things from a historical perspective, the fundamental backdrop remains so robust that there's very little reason to think that any of that is going to change in the near term.
Adrian, can fixed income investors outside of the US make investments based on these consumer balance sheets? And do they do it in the same way that Jason has touched on?
It's a little harder. The structured product market is nowhere near as developed or accessible in Europe as it might be in the US. And so I think, in terms of investment opportunities, if you are looking to exploit a robust and resurgent consumer, you have to kind of look towards either companies who are facing companies in sectors that are directly sort of in the front line, I suppose, of that activity, and that's something that our colleagues in the credit groups here in EMEA have been looking at this sort of idea of the recovery trade and looking for sectors where there is exposure to that resurgence of spending, or you look towards inflation markets. That's another, that's probably a topic that's for another day. But the subject that dominates conversation at the moment is whether we are in a period where we are facing a period of prolonged above target inflation. And if that's the case, then there are inflation-linked products in EMEA that potentially offer some opportunities, which is not to say they're cheap. And just to Jason's point about valuations, unfortunately, if you're looking for cheap assets in this market, then you can be looking for quite a long time, because the valuations you struggle to make a very convincing case, at least from a historical perspective. So really, you are kind of relying on those technical and fundamental drivers, both of which appear to remain fairly supportive.
A good note to end on. Thank you. Jason, Adrian, and Chris, thank you again for helping us on this episode of Credit Threads. I think it's been a hugely interesting conversation on the state of the consumer today. We will be back next month with another look at macroeconomics, central banks, inflation, and all of those impacts on credit markets. And of course, we will have an assessment of that Fed meeting in Jackson Hole. So thank you again to everyone, and we'll see you next time.
Important information. This is an advertisement. This podcast is intended for informational purposes only and should not be considered representative of any particular investment. This should not be considered an offer or solicitation to buy or sell any securities or other financial instruments, or to provide investment advice or services. Investing involves risk, including the risk of loss of principal. Your capital is at risk. Market risk may affect a single issuer, sector of the economy, industry, or the market as a whole. The views expressed are as of the date given, may change as market or other conditions change, and may differ from views expressed by other Columbia Threadneedle Investments associates or affiliates. This information is not intended to provide investment advice and does not take into consideration individual investor circumstances. Investment decisions should always be made based on an investor's specific financial needs, objectives, goals, time horizon, and risk tolerance. Asset classes described may not be suitable for all investors. Past performance does not guarantee future results, and no forecast should be considered a guarantee either. Information and opinions provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed. This podcast has not been reviewed by any regulatory authority. In the USA, Columbia Management Investment Advisors, LLC, CMIA, is an investment advisor registered with the US Securities and Exchange Commission. In Australia, issued by Threadneedle Investments Singapore Pte. Limited, TIS, ARBN number 600-027-414. TIS is exempt from the requirement to hold an Australian financial services licence under the Corporations Act and relies on Class Order 03/1102 in marketing and providing financial services to Australian wholesale clients as defined in Section 761G of the Corporations Act 2001. TIS is regulated in Singapore, registration number 2011015559W, by the Monetary Authority of Singapore under the Securities and Futures Act, Chapter 289, which differ from Australian laws. In Singapore, issued by Threadneedle Investments Singapore Pte. Limited, 3 Killiney Road, 07-07, Winsland House, 1, Singapore 239519, which is regulated in Singapore by the Monetary Authority of Singapore under the Securities and Futures Act, Chapter 289, registration number 2011015559W. This advertisement has not been reviewed by the Monetary Authority of Singapore. In Hong Kong, issued by Threadneedle Portfolio Services Hong Kong Limited, Unit 3004, 2 Exchange Square, 8 Connaught Place, Hong Kong, which is licensed by the Securities and Futures Commission, the SFC, to conduct Type 1 regulated activities, CE AQA 779, registered in Hong Kong under the Companies Ordinance, Chapter 622, number 1173058. In the USA, Columbia Management Investment Advisors, LLC, CMIA, is an investment advisor registered with the US Securities and Exchange Commission. In the UK, issued by Threadneedle Asset Management Limited, registered in England and Wales, registered number 573204, Cannon Place, 78 Cannon Street, London, EC4N 6AG, United Kingdom. Authorised and regulated in the UK by the Financial Conduct Authority. In the EEA, issued by Threadneedle Management Luxembourg, SA, registered with the Registre de Commerce et de Société Luxembourg, registered number B110242, 44 Rue de la Vallée, L-2661, Luxembourg, Grand Duchy of Luxembourg. For investors in the Middle East, this podcast is distributed by Columbia Threadneedle Investments, ME Limited, which is regulated by the Dubai Financial Services Authority, the DFSA. The information in this podcast is not intended as financial advice and is only intended for persons with appropriate investment knowledge who meet the regulatory criteria to be classified as a professional client or market counterparty, and no other person should act upon it. Columbia Threadneedle Investments is the global brand name of the Columbia and Threadneedle Group of Companies, columbiathreadneedle.com.